Assalamualaikum and good afternoon to our lecturer and friends. Today, our group will present about accounting treatment of musyarakah. Musyarakah is an Islamic partnership financing contract where two or more parties contribute capital to a business. Profits are shared based on an agreed ratio, while loss are shared according to the capital contributed. It is based on the principle of fairness, risk sharing, and cooperation. Islamic accounting ensures that these transactions are recorded transparently and in compliance with Sharia principle.
Musyarakah is an Islamic partnership contract involving two or more parties where each partner contribute capital in the form of cash, asset, or other resources. All partners may also participate in managing the business. This contract is based on Sharia principle of cooperation and risk sharing. Musyarakah has several key characteristics. First, all partners contribute to the capital to the venture. Second, profits are distributed based on pre-agreed ratio. Third, losses are shared according to the proportion of capital contributed. So, in addition, partners have the right to participate in management. Lastly, the contract must comply with Sharia principle, meaning it's free from riba, gharar, and maisir. So, there are two types of musyarakah. The first is permanent musyarakah, which is a long-term partnership where ownership remains with all partners throughout the contract. It is commonly used for business investment and joint ventures. And the second is diminishing musyarakah, or we can call musyarakah mutanakisah. So, where one partner gradually buys the other share. So over time, ownership shifts until one partner becomes the sole owners. So a common example is in Islamic home financing, where a bank and a customer jointly purchase a house, then the customer gradually buys the bank share.
Let's break down what each standard does and how it directly applies to our musyarakah contracts. First up is MFRS 9, which acts as the foundation for how we recognize, classify, and measure financial assets. When applied to a musyarakah contract, MFRS 9 helps us test the underlying cash flow characteristic to determine whether the financing should be classified as a financial asset on the bank's books. More importantly, it introduces the expected credit loss, which is ECL, model. Instead of waiting for a musyarakah partner to default, MFRS 9 forces us to look ahead and recognize potential impairment losses early. This drastically improves how Islamic banks manage portfolio risk. And next we have MFRS 132, which focus strictly on presentations. Its main job is to draw a clear line between what is liability and what is equity on balance sheets. In a musyarakah venture, this is crucial because it's a profit and loss sharing agreement. MFRS 132 helps us evaluate the bank's capital contribution. It establishes whether that funding behaves legally and economically like equity, or if it should be presented as a liability. Getting this right ensures our financial statements remain clear and accurate. While MFRS 132 is about how things look, MFRS 7 is about total transparency. This standard demands comprehensive disclosure regarding risk. Islamic banking relies heavily on trust, and under MFRS 7, banks are required to explicitly pull back the certain on their musyarakah portfolios. We must disclose the exact credit risk, overall financing exposures, and specific risk management practices we use to keep this partnership stable. And finally, we look at MFRS 15, which governs revenue recognitions. And the golden rule here is that revenue can only be recognized when these state performance obligations are fully satisfied. For musyarakah financing, this means that the bank cannot just book profit income arbitrarily. We use MFRS 15 to map out the venture's milestone, ensuring that profit is only timed and recognized after the agreed-upon performance obligations in the contract have actually been achieved by the business. So, to summarize, MFRS 9 measures the asset and its risk. MFRS 132 determines the place on the balance sheet. MFRS 7 ensures full disclosure to stakeholders, and MFRS 15 controls when we can actually claim our profits.
Moving on to our core recognition criteria, there are 4 key pillars we look at. First, a contractual agreement must be a formal, Sharia-compliant and legally binding contract between all partners. Second, capital contribution requires physical cash or fair value asset to actually transfer to the venture. Third, for economic benefit, future cash inflow from the venture must be highly probable. And finally, reliable measurement means the transaction value must be objectively measurable via market valuation or cash count. Next, let's look at initial recognition and disbursement. It is crucial to remember that musyarakah is treated as an investment asset, not a loan, meaning the bank assumes risk right from disbursement. For example, with a bank stake of RM 80,000 and a customer stake of RM 20,000, we record the bank's equity position by debiting musyarakah financing for 80,000 and crediting cash for 80,000. When it comes to profit relocation and realized performance, profit is shared based on a pre-agreed ratio, which is completely independent of the capital ratio. In this case, with a 70% bank share on RM 10,000, the bank share comes out to RM 7,000. We recognize this income only when realized or constructively earned, debiting cash and crediting profit income for 7,000. Finally, we have the loss absorption principle, which requires strict Sharia compliance. Unlike profit, losses must be shared strictly according to the capital contribution ratio, which is 80% for the bank. So if there is a RM 10,000 loss, the bank loss is exactly RM 8,000. This directly reduces the book value of the asset, so we debit loss on musyarakah and credit musyarakah financing for 8,000.
Next, in accounting, measurement refers to the method used to determine the value of a musyarakah investment that will be reported in the financial statement. Firstly, fair value refers to the price that will be received to sell an asset or the paid to the transfer a liability in orderly transaction between market participants. Under this method, musyarakah financing is measured based on its current market value. Any changes in the market value will be recognized in the financial statement. So the main advantage of the fair value measurement is that it reflects the current value of the investment and provide more relevant information to user of the financial statement. However, the value may fluctuate according to the market condition, and it can be difficult to determine the fair value accurately when there is no active market. Secondly, amortized costs refer to the amount at which a financial asset is measured after deducting repayments, impairment losses, and other adjustments over time. This method is commonly used for long-term financing arrangement. So the advantages of amortized costs are that it provides a more stable measurement, easier to apply in the practice. Alright, So next, this slide summarizes the difference between fair value and amortized cost. So fair value is based on the current market value of the investment, while amortized cost is based on the historical transaction value. In terms of volatility, fair value is more volatile because its value changes according to the market condition. In contrast, amortized cost is more stable because it's based on the original transaction amount. Fair value reflects the current economic value of the investment and provide more up-to-date information. However, it requires a more complex valuation process. On the other hand, amortized cost is easier to calculate and it's more stable for the long-term financial arrangement. In the conclusion, both measurement methods have their own advantages and limitations. So the choice of a measurement depends on the nature of the musyarakah contract and the requirement of the applicable accounting standard.
For recommendation, Islamic financial institutions should continue to improve compliance with Islamic accounting standards to ensure consistent and reliable reporting practices. They should also enhance the disclosure of musyarakah transactions in their financial statement to improve clarity and transparency. In addition, future research is encouraged to explore the financial challenges faced in implementing musyarakah and to examine development within different regulatory environments. So that's all from us. Thank you. In conclusion, Musyarakah is an Islamic partnership financing contract that is based on the principle of risk sharing, fairness, and cooperation between all partners involved. It plays an important role in Islamic finance as it promotes ethical and equitable financial practice. Proper accounting for musyarakah is very important because it ensures that all transactions are recorded and reported in a transparent and accountable manner. In line with Sharia requirements, this also helps to provide accurate financial information while increased confidence and trust among stakeholders in Islamic financial institutions.